Hello traders, The title of the video is how do the financial markets function or work? How do the financial markets work? Okay, so I've been asked that question over the year many times, and the time has come to answer that a difficult but essential question. I'll try to explain to traders how do the financial markets work. Well, very simple, very simple. All right, so I have here some drawing on a chart that will help you to illustrate what I'm about to discuss. All right, we're going to start with okay, a money flow. This is the money flow. You see this thing here. All right. So an asset or a financial market or a sector that where the money is going, all right, is likely to go up. So the financial markets work with money flow. Very important point. So all the time, all right, even the government want to know whether the thieves, all right, those who are committing criminal acts, they follow the money. All right, you follow the money, you find the troublemakers. That's it. Where is the money going? Where is the money coming from? So you want to send money to somewhere, okay? What the bank will ask you, they will ask you, where is the money coming from? Is it coming from your salary, business, and so on? All right. Who are you sending it to? Okay. Now, what is your relationship with that person? All right. So they ask those questions for a reason. Because when you follow the money, when you know what people are doing with the money, you can catch the criminal and know what is going on behind the scene. The same thing in the financial market. In order to understand what is going on, why sometimes the price will go up for a long time, why sometimes it go down for some time, why sometimes it goes up a little bit, and then the rest of the day it goes down. Follow the money flow. So in order to understand how the financial market work, one must pay attention to the money flow. So the general rule is that the sector or the asset where the money is going into is set on fire, so to speak. It is likely to go up. So this is my illustration for it. So the money is going into one particular area, one particular financial instrument, one particular sector, one particular industry. All right, here it is. It will likely to shine brightly and go up for some time. Okay, some even for some years. All right, this is it. Now, the next talking about the money flow, we call inflow or accumulation, all right, or investing or bullish, all right. This is it. Market sentiment is bullish. Then people open their wallet and start buying. That's why we say to traders, even if you want to buy a particular day as a day trader, swing trader, and the market is bearish, it's better not to buy that day because most people are not willing to buy when the market is bearish. All right. So you want to buy the common denominator of the beginning of any bullish move is what? The sentiment. Was he bullish that day? Market was bullish. Everybody saying that, oh, now the conflict between China and United States is resolved. Or business are not going to suffer anymore. Everybody say they talk about it on television everywhere. This is a good sentiment for a bullish market to start with. Okay, so this is it. Money coming into a sector likely to go up, provided that the market sentiment is bullish. Sometimes they forget about the market sentiment or the market environment. All right. So even if the money start going to that sector and then the sentiment change, becoming bearish, suddenly something happen and the sentiment change, they will start coming out quickly. So they enter fast, they can also come out very fast if the market sentiment. So if the market sentiment remain bullish, so this is about the environment. the season, the time, all right? And everything's nice, sometimes things work beautifully, right? Here it is, and then they will continue to buy because the market, talking about the financial market, does not like uncertainty and fear. So you start getting afraid. There are a lot of uncertainty going on. That issue is not resolved. People wondering what may happen. Now it creates uncertainty. People, even if they interfere, they can still come out. So it's not because the market, people are going to that sector, that buying that asset, that the market sentiment will stay bullish. If people are start buying it, and then suddenly the sentiment change, you may have a sharp correction and everything change, game over, full stop. The music has changed. It's not reggae anymore. My friend, it's time to change the steps. Don't keep dancing reggae when something else is going on. The music in the financial market is about the sentiment. That's why sometimes people say, believe the rumor. So people talking about something, they keep talking about it. Everybody is talking about it. It's all over the place. You need to take into consideration. Don't ignore it. It doesn't mean make decision according to the rumor, but it means that don't ignore it. Acknowledge it and take into consideration in your decision. Don't say that everybody's foolish and you are the smartest guy. That's it. So where is money going into? Likely to go out, provided that the market sentiment is bullish. If the market sentiment has will changes, all right, everything is back to okay the starting point. Okay, nothing will remain intact forever. That's why we manage the trade. That's why we don't just buy and say that's it. I'm now in the third year wave. Okay, forget about it. All right, I don't want to move my stop loss. I don't want to have any defensive measure or hedging strategy in place. It's all good. All right, and then suddenly people wonder where this is going on. They say, "Oh, Joe, you say that we are now in the third year wave. What's going on?" Okay. The next thing that talking about money flow is the sector where the money is coming out from. You have to understand that most market participants are bullish. They don't know how to sell or they don't want to sell. All right. So financial markets usually go down very fast, very, very, very fast. All right. So market may take maybe 7 years going up or more. All right. 2012 to 2018. And then in one day, it can erase 50% of, or not in one day, one week can erase 50% of that 7 month activity. Sharp correction. People wonder, oh, where this is coming from. Because of fear and uncertainty, people start divesting very fast. So the market will go down faster than it goes up. You need to understand that. That's why the smartest technical traders are bearish traders because they want to get paid very fast. And they get paid very fast. When I need to make this confession. When I start trading fast, I sell more than I buy. In fact, I consider myself as a very good bearish trader. It doesn't mean that I'm an evil trader, as some traders call bearish traders. I'm not a bearish trader. Over the year, I have learned that it's better to be bearish and bullish. So I can buy, I can sell. But I think I'm very good at selling. All right. That's another matter. All right. Okay. So mm, most traders, most market participants don't like to sell. All right. So they come out, they all just come out, okay, very fast, and everything crash down. But they don't sell when there is an opportunity to sell because they don't understand it or they don't know how to do it. So pride goes, everybody doing the same thing, pride crashing down very fast. Not always, but usually that's the case. See here? See, see how he drop it down? Very fast. Again, you see that very often, right? If you consider among the monthly chart, how many months we have in this session to bring there to the same session from here, how many months it took us from here all the way to the top there? Many months. But look at that. Few months only. They bring it back to the same place. So because of that activity, a lot of people don't know how to sell and they all come out. the market usually will go down very fast, meaning that everybody taking their money out. So money flow. This is inflow, outflow. So the inflow is accumulation happening gently, gently, gently over the year. People coming in. So first buyer buy first. They know that the stock is go up. Those are intelligent, smart market participants. They create the trend. If they pull out, the trend will fail. Okay? There's always first buyers. There are people who are like the foundation of the trend. If they come out, the trend will fail. And then the general market join them. Well, okay? The third trader will join them. Okay? During the third wave, they rushing everybody buying, blah, 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 like crazy. All right? And now, okay? And now the trend is money is coming in gently at different stages during the bullish trend, which is normal. So the progression is almost diagonal. But very often, when people are selling, because people are afraid quite often, they say the stock market went down 500 people. But if the stock market went up 500 people, everybody's sure. But I can assure you when stock market Dow Jones went down 500 people are very, very afraid. It's dangerous for the Dow Jones to go down 500 because it creates a higher level of fear than anything else. So the bearish price move intensifies, okay, the fear in the financial market. And what usually happens, instead of people coming out gently, gently, it's like you are in a room, they say, oh, there is a fire. People, everybody rushing through the door. But if you ask people, you ask a group of people to enter a room, they take time to enter the room, yes or no. They just go nicely one to one, talking to each other, and then they enter the building. But suppose they are already in the building, they say, there is a fire. You see the stampede, people rushing out, rushing through the door. The same thing is happening in financial market. That's why the price may go down very fast. So w- most market participants, all right, are paying attention to the money flow. Where is the money going into? Where is the money coming out from? So right now, the stock market is approaching the fifth wave. There's one more move up, and after that, all right, the smart money will start thinking, well, is it going to go up more? Is there an extension due? They'll be checking the fundamental and so on. So when they start coming out of the stock market, people will be wondering where the money should go now. You go into gold, you go to commodity. All right, that's it. It may go to bond, provided that the central bank are likely to continue to put out interest rate, which I explained today in another tutorial, talking about simple hedging strategies that have stood times at a Joe Trio YouTube channel. So inflow and outflow. So I explained to you that it's not because one is going to one sector that one should buy anyhow. One should pay attention to the market sentiment. But generally, when people start selling, they fear it's like how should I put it? It's like a low temperature. People get frozen, so they stay in that state for a long time. They are afraid, even if it's over. It take a lot of time. If I show you now, I don't want to change this screen now. So if you say to people that the market is now is about to go up, they're still afraid even at the end of the bearish move because as I told you, most people do not know how to sell, so they lose when the market is going down. So they are losing when the market is going down, or they are keep buying thinking that you go back up because they don't understand the market cycle, and therefore it's a bad experience for them. And then when the market is about to change at the end of the correction, people are still afraid. They're still afraid. They don't want to come near the stock market, or they will run away from the stock market once and for all because they don't understand what's going on. They think that the market should go up forever. They think that the market sentiment is always up, that other people are wrong. And now this is it. Follow the money. Okay? The next thing that I want to say to traders when we want to explain how do financial market work, we need to talk about entry and exit. Now, when we are talking about entry and exit, all right, we are also talking about open and close. This is it. This is about the market timing. So there is money going to that sector. There is, okay, market sentiment that is bullish, all right? Is the door open? Are you going through the entry? What is the time? The time, 53 minutes past 9. This is about entry and exit. A lot of ordinary investors, long-term investors that buy a hold, do not understand this thing about entry and exit. So all they are looking for is, oh, what should we buy now, guys? Have some money because they are very rich, a deep pocket, all right. So they are looking all the time to buy. Can you believe that? That's crazy. That's really crazy, all right. People coming to the market, all right. So imagine you go to a market. This is a very important point. Is how irrational that behavior is. Can you imagine you go to a marketplace? What do we have in the marketplace? We have people selling good, yes or no? Have you ever been to a market when everybody just want to buy? So who is going to sell? You go to a marketplace, all you see, everybody standing there say, I want to buy something, 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 I want to buy something. What are the sellers? This is it. You see? So it's completely irrational and crazy to be 100% bullish all the time. I mean, I'm not saying that if you know that it's not the best time to buy, just go away from the market. Take a pause, take a holiday, go somewhere. And then when it's time to buy, come at the right season to buy. That's what I'm saying. I'm not mocking people, but I'm giving a bit of example here so that they may understand that it's completely irrational that people may think that in the financial market they should only buy, that there's no sellers. There are sellers in every market. In fact, the seller that are inviting the buyers, because if no one is selling, well, what are you going to buy? You go on the internet, you want to buy. You're looking for something to buy on Amazon. Everybody want to buy. So that's it. That's the end of Amazon. If there's no sellers, there must be a flow. Buyers and sellers is what's going on all the time. But when we are talking about the entry and the exit, as I was mocking a little bit, the traditional long-term investor that do not understand what we mean by entry and exit, we are talking about market timing. Take it from me. I said this before. The financial market has a cycle. It will go up, which we call a trending phase, and we will have what we call a corrective phase. Even during the trending phase, we have again the second wave and the fourth wave. Any price move, there is a pullback. You see here, it's going from here to here. Right? And you go one, you see, and you pull back, and then like this, and this, and this. So here, if I explain it to you now, here it is. For somebody that is swing trading, this is an entry there. It went up, it pulled back. Common sense is broken. If you're on a monthly chart, you want to cut this one early stage, either you wait for the weekly currency bar to close at least above this common sense. This is about the entry. Now, the price does not go up or down for no reason. It's always headed to a specific target level. So when the price finally, or the asset or the markets, finally the financial markets in general reach a target level, all right, or a terminus or a terminal, people must exit. They must come out. Oh no, people don't want to come out. So you have a room or a space where people want to come in more. So people want to come in more. People want to come in more. No one want to come out. Okay, so everybody that goes in doesn't want to come out. So they say, "I'm staying. I'm staying put." This is what happened to Bitcoin traders. Right, when Bitcoin came down, okay, it was going up. Everybody just want to come in. So everybody going through the door, and no one want to come out. So those who went in are still in there. They're not coming. You know what's happening in London? In many cities, all right, in many cities, what we call a rush hour, okay, big cities, all right, peak time, people going to work. In London, there are times when the British Transport Police will block the station. They will close it temporarily because the amount of people getting into the station at the same time is too much. It's dangerous. So if anything happens, the evacuation will be completely impossible. So for those reasons, they will shut the station down. You see somebody standing there, not because the station is closed, but it's shut down for a few minutes or so, or 30 minutes or so, and then they reopen it again to control the flow. But what we see sometimes, that's why you will see sometimes the price goes up, okay, very far, and then you see it start consolidating. This is if you see that, you know that there is a congestion. That's why we say congestion, consolidation, and so on. Somebody should control the flow. So after the flow is controlled, all right, then the price is free to decide where to go next. So there is always entry and there is exit. All right. And when we are talking about the entry and the exit, we must consider the time when we are entering the market to buy or to sell. Talking about the entry and the exit, especially the exit, when one is taking position in the financial market, one should know when to come out. If one does not know, one can be victim of stampede, which means other people will go over you and then it crash like this few. So they stamping on people and they mess up people. So this is what so yeah, there was a bit of congestion here, and this is the stampede or sharp correction. So the entry, all right, yes, but you go in, understand that know when to come to the exit door. Otherwise, you will get into a stampede and so on and so on. Entry and exit, we were talking about market serving. All right. So watch the money flow, all right, and pay attention to the market timing, and you'll be all right. Now, to separate a bit the entry and the exit from open and close, all right, open and close, is that there are sometimes many doors that are open along the way. So price going up, okay, people are entering in different places, all right. Sometimes when we are talking about open, suppose, all right, suppose this is very important. Talking about the open, I want to dwell on it a little bit more so you may understand it. Okay, suppose you enter a trend, okay, and you are using, for instance, this very important point. You are using 100 pips stop loss. I will tell you a story that I said many times before for new trader. So you are using 100 pistol loss. So you are swing trading. You say, all right, due to the volatility and the characteristic of the financial instrument, I will use 100 pips stop loss. Okay. We are talking about the open. Okay. So you have done everything. You use the top down trading method. Okay. You apply the top down trading method. You say, I will follow the advice of this stupid George on YouTube. And then you can say, that's exactly what he said. Okay, so you enter the trade, as George said, double top or double bottom. Okay, mark the crossable signal line. You implement the top down trading method. You hide the high, the low, and the median line of okay the monthly chart. You pull back to the median line, commercial and broker. You take it like a pro. All right, you use your stop loss 100 pip. You are very proud of yourself that you have done the right thing, and you are smiling. Probably, all right. You're banging the table, kissing your wife, jumping up and down, okay, all kind of thing going on, excitement coming in. But few hours or 2 days later, you come back, okay, where are we? You are very surprised the price was going up fast. Here it is. Now you are down almost 90 pips. Okay, so they are putting you under pressure. So 10 pips left for them to take you out. Okay, you are sweating like a donkey, which is normal, all right. I'll tell you a story in a minute so you don't feel okay too bad because you are not the only one. I'll tell you a story in a minute. Okay? You're sweating like a donkey, okay? You feel the pressure, okay? You call your mom, you say, Mom, I love you. You say everything okay. You say yes, it's okay. You don't want to talk about it, you keep quiet, but it's your mother can sense and feel that something is not right. Say, is everything okay? You say yes, is everything okay? Say yes, everything is okay. All right. Because you know that soon they may take you out. Okay? So you walk away, you think that, okay, that's it. I'm going to lose. Okay, I'm going to lose. They're going to take me out. All right. You forget about the trade. You shut the computer down. You give up. You say, all right, that's stupid, George. I will never watch his video again. Okay. All right. So the following day, what has happened? You come back slowly but gently. You open your computer. A few hours later, you check it. Here it is. It went back up, all right, to your entry point, and you are very surprised. Say, what? They went back up to the entry point, all right? Or they went back even above the entry point, and you are in profit. This is about the door open. Now you have to make a decision now, all right? You have to make a decision now whether you're first, they let you off. This is what I meant by open. Sometimes the market will let you off for a reason. It doesn't mean that you are off the hook. The question now is how are you going to take it from there? There is a lesson learned. You were almost taken out of your train, and now suddenly the door that was closed before, you thought that you were done, finished, and now the door is open. You need to react, you need to take decision when the door is open. And most of the time, a lot of traders don't make decision. A simple thing that one can do here, maybe you can reduce your stop loss to 50 pip because you didn't like it when they were about to take you out with 100 pip. You may decide to move your stop loss to 50 pip. You may decide to close the trade after looking at how you enter the trade and say, well, I did everything right by the book, technically speaking, but I didn't pay attention to the economy news and the fundamental. Now you go and check quickly, say, oops, well, they let me off, the door is open. I don't like this very much. You go. Or you control it and manage it until you get paid, or you reduce the door. This is you reduce your losses or your exposure. This is about the door opening, meaning that they put you under pressure, they try to mess you up, but they let you off. Off, starting with O, door opening. Make a decision, my friend, and take that chance and enjoy it. This is it. All right. Now there are times when the door will stay closed. All right. This is it. Door is closed. All right. The door is closed. Where, for instance, I'll give one example. Is this very simple? So you are using your 100 pips. I will stick to that again. And the price was at 90 pips. They push you under pressure. They're about to take you out. There's 10 pips left. Okay. All right. So you say, all right, I lost last time. I've been losing. I don't want to be taken out with 100 pips. Now you move your stop loss down 50 pips. So it's now 100 pips. Okay. You decided to do it. It's your decision to move your stop loss. But you decided to increase the risk that you are taking. All right. Price continue to go down. Now it comes down to 140 pips. Okay. So you say, all right, for the last time, I'll move it down again 20 pips. Move it down 20 pips. All right. So price went down again. So you are now risking 170 pips. Okay. So now the price is now 100 is you are now 160 pip down. Okay. Are you going to keep moving that stop loss? Are you going to double your initial stop loss? In that case, what? The door is closed. Talking about the door is closed is the same thing when traders are violating the market pattern. The price is stuck in a declining channel. People keep buying. I mean, if you know what you are doing, which some trader can do, they are buying here, they come in out there, they know what they're doing, that's called. This is closed for bullish traders. But people, sometimes they forget about that. The door is closed, but people want to buy. They are forcing it through, and they are calling the bearish traders the evil traders. The door is closed. The door is closed. That's it. It's closed. It's closed. That's it, my friend. All right. One must wait until it's open again. Break a ball, retest it around. This is it. All right. The same thing for bearish traders. Okay, I want to sell, I want to sell, I want to sell. I want to sell like George. George said that the price go down faster. Oh, I love to sell. And you want to sell, but the price is in a rising channel. Or sometimes the door is closed. I will explain another example for you. When, okay, we are applying a top-down training method, this is it. The setup, you validated your setup, everything looks good. You examine the foundation of that setup, and you say, all right, that's a special double bottom chart pattern, 1, 2, 3, 1, 2, 3. I wait for it to come to me nicely. Now here it is. Common setup is broken. I implement it. I want to implement it top-down training. So the setup is good. All right. Or you break below, retest it nicely. The monthly candle bar is closed. Now you go on a signal time frame. You say, George said that the signal time frame. All right, this is another setup on the signal time frame. By the book, signal is fired. You see, no question about it. This is the signal. All right. So the setup was good. All right. The signal was good. Now you are getting ready to enter the trade. You want to take a bullish trade. You want to watch the market is sentiment, yes or no? So we want to take a bullish trade, but the market sentiment is bearish. It means that the door is closed. I mean, if we want to proceed, which sometimes we do, we need to be careful. The door is closed. You want to enter. How do we enter, my friend? You must use a key to open the door or find another entry. That's it. You don't want to smash the door, yes or no? Yeah, it is. So the door is closed. You've done everything. You've done your verification. On that particular day, the market was really bearish. Everybody's talking about it. The Dow Jones went down 500%, but in reality, you want to enter. Don't do it. You can wait. You can wait. That's it. The door is closed. Or sometimes you are on the signal, you want to enter time frame now. You've done everything now. You want to enter. You are just waiting to enter your trade, all right? So you are looking for a scenario to occur on the entry time frame because it's another signal on the entry time frame. And behold, other traders, believe me, other traders are playing with you, mind game, by doing all kind of things. And the way you want it to set, remember the video about the markets coming to you, explain at Jotrio. Check it out. Normally, one should wait for the market to come to you, yes or no. You see, but sometimes you'll be forced sometime or obliged or tricked even into entering the trade when you're not supposed to. You see, this kind of bar here, this is what a hammer is in. So usually when people see hammer, they think that hammer is what a pin bar. There are a little bit different between a hammer and a pin bar. Now, how do you trade the hammer is different than the way we trade. We trade the pin bar. All right? There's a different way we trade the pin bar. They trade the way we trade the hammer. The hammer, people, the hammer candlestick bar, it means that you have that candlestick bar plus a bullish candlestick bar that is not very long. That's why that's the normal. Can I see one somewhere here? Uh, this is look more like a pin bar. This one because the tail is too long. This look more like a pin bar to me. This is, or you see, the next candlestick bar is too long. So if you call it one hammer, it's too long. Uh, so we want the next candlestick bar to be bullish after the hammer. That's normally what we are looking for when we are talking about a hammer, a candlestick bar trading. It's different from the pin bar, all right? So sometimes traders will be forced or tricked into entering the trade while the door is still closed. It means that the setup is that they are expecting that they are waiting for did not take place, but they get into it or they try to go through a closed door. Unless you have some supernatural power, you may do so. So all in all, I think I've said enough now. We don't want the video to be too long. 34 minutes, that's enough. See? Okay. So all in all, that's what we can say about the stock markets. Okay. How the financial market work in a nutshell. I can go on and on talking about hedging, all right, arbitrage, blah 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 blah. But in a nutshell, we are talking about money flow, inflow, and outflow. Money usually come into the market gradually, all right, and provided that the market sentiment is holding it nicely, it will continue to go up. But if it's going up and the market sentiment really change, all right, really change, it will come back down. It will change direction, all right. Now, money usually come out of a sector or out of an asset very fast, at a faster rate, because of the fear and everything that I said before. People are coming out very fast. Okay. Now, in the financial market, the timing is so important, and it will help you to make decisions. So this is about entry and exit. So think of money flow, inflow, outflow of money, accumulation, distribution. All right. The distribution will take first very fast. The accumulation can take ages. That's why you see sometimes the price may consolidate in a triangle for a long time, even years, or in horizontal channel because the entry can take ages. All right. But when there is a distribution, usually we see one, two, three, blah blah blah, everybody jumping out. All right. And the entry, we are talking about the time market timing. When one enter a trade, one enters the market, one should not forget that there is a target that the price is headed to. One should be prepared to come out. If you find yourself in a position where you don't want to come out for too long, ask yourself, is it time to exit the trade? Are we at the target level? Or are we at the end of the trend? And so on and so on. Is it at a reversal point? It's about market timing, the entry and the exit. Usually people will enter the market, but they will forget to exit the market. They think that they should remain there. No, you go in, there is a time when you need to come out. If you stay too long and you go over the time, it becomes a stampede or a market crash. So this is about entry and exit. The next thing that we are discussing is about the opening and the close. When the market will let you off. There are times people hold position, all right, millions of dollars. Ask the hedge fund, ask the investment bank. Sometimes they are losing billions, all right. You know, if you look their portfolio, it's all red, all right, really red. So traders that are managing that portfolio are under pressure. In fact, we can imagine that they have a red eyes, all right. They seeing it, it's going down. It's not okay pitying anybody. All right, that's it. But and then suddenly the market will let you off, or it will bounce off, and then you wonder, and something may happen, giving you a door to come out or to reduce your loss. That's why sometimes you will see it. All right, the price will run very fast, and you see some activity in the market. You wonder what's going on. Somebody is happy to get out. All right, this is it. Somebody is happy to get out before it is too late. This is about opening. Same thing, you are swing trading, day trading, scalping. Sometimes the market will try to take you out and then let you off. Now, if you notice that you can't take that loss, all right, you can't take 200 people loss, it's going to wipe out your account, or you have neglected the 5% money by your own, and then suddenly they let you off the hook a bit. It's time to make some decision. I'm not saying that in that case all the time one should close the trade, but there are decisions to make. So when you look back, you may say that, all right, I done the right thing. So I promise you that I will tell you a story, which I forget now. Let me tell you quickly the story. It's one time I took a position as a new trader, trading indices. So I opened position buying. In fact, I was buying a FTSE 100, Dow Jones, Nasdaq, most of the indices. All right, I have it there as a new trader, sitting there in the morning watching the screen, all green, all green, all green, all green. So happy, all right. So excited. Believe me, my friend, this is during the London session before New York open, I have position open, and then New York is open, I had my position. And then suddenly the market changed direction. Now, for me as a new trader at that time, okay, trading with a small account, all right, they nearly take my almost 1,000, okay, British pound. And I couldn't take it. How a trade all green in the morning, I look at it, all green, just going up and wonder how I did it, all right? I couldn't understand how I did it. I see it all going up nice. I said, wow, I'm going to be rich at the end of the day today. And then suddenly it just changed, my friend, just changed. Hey, it's just going on. And they're just going to wipe me out completely with that money in one day. Now, I said this story 100 times before, and I end up, okay, this is a true story. I went back into the bath, spent, okay, hours in the bath, okay, hoping that all went well. Believe me, before the market ends, the door was open for me. They let me off the hook. And I will never forget that. This is about the door opening. All right. Sometimes the door will remain closed. So we move sometimes our position. So you buy, okay, you buy. Okay, if I went down, you move your stop loss. Okay, and then it come again near you. It's telling you, I'm not smiling today, and then you move it again. How far are you going to move it? Because the door is closed, it's closed. Or sometimes you are buying when the price in the declining channel, or you are selling when the price in the rising channel. How far are you going to push it when the door is closed? So this will conclude our discussion today about how do financial market work. Have any question, suggestion, blah blah blah, please put it in the comment section. And of course, I will be recording another video to answer your specific question. If this video has been truly useful to you, please let us know by giving us the thumbs up. If you dislike it, be sure to mark it down. If you think it's an essential tutorial, feel free to share with your friend on the social media. All right? Very important. All right. Subscribe to our YouTube channel. Our YouTube channel is George Trio. Be sure to click on the notification bell so anytime we record a new video, you will be the first person to be notified. Okay. I would like to take this opportunity also to apologize to traders. Last week we have some issues with the sound. All right. I have removed some software from my computers, blah blah blah, that were messing up a bit with the okay, blah blah blah. So hopefully the sound will be good this time. Okay. All in all, this is it. How do financial markets work? Probably in the next time we'll be talking about how okay one can be a better financial market participant. Okay. So if you have any question, please put in the comment section, and that will give us a good excuse to record another tutorial. Happy trading to you all, and I will speak to you soon. We are the TSTWSYS008 traders barking about how do financial markets work. Thank you for watching, and I will speak to you soon. Happy trading to you all.